The Emerge Digital Freight Marketplace, the fastest, easiest way to manage your carriers and brokers, and receive live direct rates from vetted carriers outside of your network. Users are saving upwards of 20%. The Emerge Digital Freight Marketplace. Quote, tender, track, save.
Hey everybody, welcome to FreightWaves 2020 Freight Outlook presented by Emerge. I'm joined today by
Kevin Hill.
Anthony Smith.
And what do you gentlemen do around here?
I'm the Director of Research here at FreightWaves, and Anthony, you are?
I'm an economist.
Nice.
You are an economist,
I'm an
aren't
economist.
you? Yes.
You guys are going to run us through some of this stuff. We'll also be joined by JP Hampstead. He is the Senior Director of Passport Research here at FreightWaves. Right? He's going to cover some stuff. Mike Budensteel?
Bowden-Distel.
Bowden-Distel. He'll be talking about intermodal, right? The outlook for intermodal and the rail. JT Engstrom, our Chief Strategy Officer, is going to talk about...
Talk about the market.
Yeah.
Just talk about the market in whole.
The market and the outlooks on that. And founder and CEO Craig Fuller will be here as well. And I believe we may have a call-in number that we're going to put out in a little bit. So if you have any questions for those guys, they'll give you the roundup and all the full details.
That's right.
Yeah.
So guys, let's kick it off. What do you want to talk about first? What is set the table here?
So our outlook it takes several different modes of trucking and transportation and kind of gives our outlook, what we're seeing in the market through sonar and other data points that we have. And basically our forecast starts off with, it's a top-down forecast. We start out with a macroeconomic forecast. What's the economy going to be like? What's the freight economy going to be like? And then we move into trucking. And how's that going to affect trucking? We look at some historical data sets like outbound tender volumes, outbound tender rejects, and we take a gauge of demand and capacity for the full truckload market, and we see where rates are likely to go directionally over the next 12 months. And then we looked at intermodal, because intermodal and trucking compete quite a bit, especially right here at the bottom of the rate cycle. And then, Craig and JT will come in and give their outlook on all that information as well.
That's right.
So let's kick it off with...
what do you guys want to start out with?
Let's start out with the first, which is the macroeconomic forecast. What's the retail economy going to do? What's the industrial? What's housing? What's oil going to do? So let's kick it off, Anthony.
Yeah, let's do it. So one of the most relevant headline items, GDP was just released yesterday, right?
Yes.
So we just saw that the fourth quarter results for 2019 came out. And so what we saw wasn't too much of a surprise from what we were expecting internally. We saw a strong showing for the consumer side of the economy. They finished the year off pretty strongly. They really did their part to uphold overall growth in the economy. Where we did see some downward movement was on that business investment side. And so there was a little bit of a give and take here. And so it's reasonable that we see that downward momentum on that business investment, especially with all we had going on during the fourth quarter with trade tensions and things like that, really kind of impeding business uncertainty or business investments and uncertainty.
And that has a lot to do with capital expenditures.
Yeah.
Do you think that's more a demand type of lack of business investment going forward, or is that you have trade wars, you have some uncertainty, now you have the coronavirus in China? Where do you see why was business investment so light?
So I think it really came down to that uncertainty aspect of it all. Not really sure what's going to happen with the whole trade war with China, tensions with that. But I think that's going to be a little bit lackluster continuing into the first few months of 2020. Even all the way up until like maybe the second quarter, mid of the second quarter. But I think that's going to start to kind of ramp up as we get closer into the middle of the year. We had the phase one deal come through. I think that's going to be between that and the USMCA. I think that's
that was just signed this week too.
Yeah,
right?
just signed this week. So I think both of those things are going to help boost some confidence. I think it's going to have a lot of implications for especially farmers are going to benefit really well here in North America. They had a rough year in 2019.
They did, yes.
So I think that's really going to help out, especially refrigerated reefer trailers as we're going into 2020.
How about flatbeds? Let's talk about flatbeds because that's tied really into construction, which is your niche within economics, right? You love constructions, housing starts, commercial construction. So what's the outlook for 2020 in industrial and manufacturing and construction?
Yeah, and so let's look at the consumer side. The consumer side, there's been a ton of pent-up demand. All the way since, I would say, mid-2019 on, there's been a huge demand for entry-level homes. And that demand hasn't been able to be really satisfied. And that's really due to supply-side issues. And those supply-side issues also mean fewer and fewer building products being transported via flatbed throughout the country when we're looking at residential construction.
Anthony, how is a entry-level home decided? Is there a cost barrier there? I understand it's just consumer sentiment of wanting their first home, but is there... It has to depend on markets.
Yeah, it definitely depends on region because Northeast entry level homes is going to be a little bit more pricier.
Yeah, I was going to say parts where we're from, it was like 450, 550,000 entry level home.
Right. And so typically I'm looking at markets at around the 150 mark to maybe $250,000 mark for those entry level homes. That are really
so not
no.
And that's the other thing with construction in Massachusetts in the Northeast and New England area, much more mature market. So fewer homes being built, a lot more multifamily homes and things like that. And so that's really going to also play into kind of some of the demand going to those areas. But we did see that there was a lack of available labor, a lack of for existing homes, a lack of inventory on those homes for the entry level, and a lack of available lots. And then a few regulations, especially in California, that really impeded some of that growth.
Like AB5 and a couple others, definitely.
Yeah, and so that's really going to really be a potential headwind for some of the flatbed transport. But the good thing is that demand is there, especially with mortgage rates.
It's good, and not only on the demand side or load volume side, but both construction and oil as well. And oil's in the 50s right now. So, and I don't really see a rebound this year. I don't know if you agree with that or not. But both of those industries really compete for the driver labor pool. And with the unemployment, I think we're still around 3.5%. Everyone is highly competing or being highly competitive to find, whether it's construction workers, manufacturing workers, oil workers. And all of those compete with drivers, which is a very competitive market for trucking companies.
Right, and the JOLTS puts out the quit rate, and that's very high right now. So consumers are feeling confident. And when we're looking at the overall market for construction, that's really going to be the impedance. It's going to be, are we going to have enough labor? And that aspect is going to really start to draw in that pricing point and start pushing that pricing point up. On a business side, there has not been a lot of movement for commercial construction. There's a huge demand for warehouse construction, especially as we're getting more and more involved with overnight deliveries
e-commerce,
and e-commerce.
Amazon.
So there's going to be a huge demand for that. And so I think that's really going to be a nice pull when we start getting into those really busy construction seasons, especially in the second half of 2020.
Now, Anthony, you deal a lot in sentiment and forecasting sentiment and those kind of things. So interesting year that we're coming into, right? So you mentioned those trade agreements, but the other thing that's happened has been the coronavirus, right?
Yeah.
No real world impacts on freight, but does the specter of it create any situations? Because the news starts using scary terms like pandemic, and you can even see it in media. If you go on YouTube, like my YouTube all of a sudden has all these virus videos on it. Netflix, I open it up, and there's a trailer for an entire series. So how do they have that timed out so perfectly? I don't know.
Yeah.
But a series, pandemic, dropped right as this thing was happening.
Yeah.
Talk about viral marketing.
Right.
But honestly, will this have any impact beyond just being something, unless worst case scenario, but in general, will this have a long-term lasting effect?
I don't think it'll have a long-term lasting effect because I think the U.S. economy has such short memories. Everything, even like if you're looking at like memes almost like joke, like make everything into a joke, and then like everything is just like people have such short memories. But I do think when we're looking at the coronavirus, I think that's going to have an impact for sure on consumer confidence, consumer sentiment. We're moving into the next month. So I believe the Conference Board, the most recent consumer confidence index that they just put out cuts off at the 15th. And so that was really kind of the cutoff before we really start to see much from the coronavirus. And so I think in the next series for the sentiment, I think that's going to be a bit of a blip, but I don't think there's going to be anything long term.
What about manufacturing? I don't think we've really delved into manufacturing. You have the ISM PMI that's since the last 6 to 9 months has kind of plummeted into contractionary levels, even with 3.5% unemployment. And a few manufacturers I was reading in the Wall Street Journal a couple of weeks ago are now for $12, $13 an hour jobs or paying relocation fees.
Right.
But you still have like a contractionary environment. Can you throw some color onto that? Yeah,
and so I think that was really, amplified through that whole trade tension thing. And so I think that what we're seeing when we look at the PMI, of course, it's broken down into different components. There's new orders, there's backlogs. And what we're seeing is that there hasn't been that spur for new orders just yet. And so that's really going to be indicative of what gets produced. And then those things that get produced are going to be indicative of things that can get shipped and hauled by freight throughout the country. And we're not seeing a lot of catalysts just yet, but we are seeing the foundation with the phase 1 trade deal with the USMCA. And so those are promising things. We're also going to start to expect business-to-business activity start to slowly pick up around that March, April timeframe. And that's really going to be, I think, a nice boost to manufacturing. But really, when I'm looking at industrial production, when I'm looking at the ISM numbers, if we have a blip up, I think it's going to be due to irrational swings. So like maybe for defense spending or maybe something like that. But I don't really see anything right now that is going to really promote a sustained rise early on in the year.
So the BGSA annual conference, they did a survey, and logistics businesses, transportation executives expect their businesses to grow by more than 10% in 2020. When there's something like that and that sort of confidence, does it usually follow suit? Will they grow by 10%? Do you think that?
I think I put a lot into confidence. But there's also that real world. Zach Strickland and I go back and forth on this all the time. But those real numbers with the confidence numbers, and the confidence is good on the front end because now these plans get put in place and all that good stuff. And also when you're planning ahead of the rise, that's the right time to be planning. And when you're planning ahead of a decline, that's the right time to be planning. So I think them planning ahead before that cyclical rise is right in front of our face, because that's when it's already too late. I think that's really a good sign. So good on them, because right now is a good time to be planning for that kind of stuff.
Well, and you kind of said it right there, because growth was 5% or under last year, so not great. But maybe that's when it's sort of like how if you're smart, how you buy stocks. When they go down, you go, this is a great value. I think it's going to rebound, and I think enough other people are that it's going to elevate it, and that's what you're kind of seeing in the market too?
Definitely. I think now when it's like it's slowing down, there's maybe some contraction. You can, as bad as it sounds, you can play on people's pessimism. You can start to really make strategic acquisitions. You can start capturing market share. And so this is really the time to like really pivot and really position yourself, get rid of any redundancies, really make sure there's no bottlenecks that would really hinder any kind of ramp ups.
Yeah, and if you think about it, the logistics industry has grown over the last couple of decades at 7.9% compounded annually.
Yeah.
So if you have a 5% year, which is a down year of 2019 in the freight industry, 10%'s not too off the board on a sentiment survey or a confidence level, right? Whether it'll get up to 10%, the long-term trend says that it probably has a pretty good shot.
Right.
Yeah.
Right.
The LMI2 Logistics Managers Index, we have about 1 minute left. Are you a fan of that one?
I'm a fan of it. Zach and Dale Rogers over at Arizona State, Colorado State, and all those other schools, Reno, Nevada, Rochester Institute of Technology. I'm a big fan of it because it captures not just the confidence side or the consumer side, it also captures the manufacturing side.
Yeah.
And so when we can see the different breakouts from warehousing prices to transportation prices, I'm going to keep my eye on that index as I'm moving throughout the year.
Well, in December, it was at its lowest level
Yeah.
in history, but the good news is it's expected to go up to 63.3%.
Yeah, so they have some
specific.
they have some expectations of rise moving forward, and so I think that's another thing is that expectation, and sometimes those expectations lead real world trends, and it's that part of that argument. If you think it's going to go up, it's going to go up. That whole mindset thing, But I'm excited about 2020 overall, especially the second half. I think that's really going to become the mantra for the industry, so to speak. And so, but yeah, the LMI, great index to follow.
Thanks for joining us.
Thanks for having me.
Thank you.
The A train of ecom is
Yes.
Anthony Smith.
I'm here.
Doing a wonderful job showing his outlook on the macro side. And if you like more of that, check out his show Freightonomics on Apple Podcasts, Spotify, Stitcher, or subscribe to Freightcast and get every FreightWaves podcast, including Great Quarter, guys, including What the Truck, FreightWaves Insiders,
And a
all
new
that
one.
good stuff. Yes.
And a new podcast.
Yes. What is it?
Put that coffee down.
Put that coffee down.
All
JP,
about freight sales.
Coffees for closers.
Bring us that
Coffees for
coffee, my
closers.
friend.
And if you want the entire report, the 2020 Freight Outlook is about 32 pages, analysis, a lot of supplementary data from Sonar, where we got most of our information from. You can go to freightwaves.com, look for that article, and download the report right there.
Yeah. Delicious stuff. And
Yeah, I know.
speaking of delicious stuff, it is John Paul Hamstead. He is the director of Passport Research. Just tell people really quick what that is before we even jump into the trucking outlook.
Sure. Passport is a subscription service that FreightWaves offers to our most sort of engaged audience members. It gives people access to proprietary research products, discounted access to events and exclusive events, and also continuing education products and events for the C-suite.
And it's been great reception for it. The people who already know about it seem to like it a lot. And if you're into research and if you're watching a show like this, you're probably the target audience for the Passport Research.
Yeah, like our whole philosophy is that the best way to get at like accurate analyses of the freight markets is to triangulate a variety of viewpoints. And so we have like a Slack channel, for example, where we bring in people from all different companies and we talk about data and the markets and things like that. It's been really great so far.
Well, guys,
You guys produce about 3 articles or 3 research reports a week, so that it just keeps flowing.
Yeah,
Yeah,
we
it
keeps
do.
flowing.
We do a trucking markets report every week and an intermodal markets report every week, and then we do a special topics that can be anything from the coronavirus to asset prices like truck markets, anything like that.
Yep.
let's get to them. Trucking demand,
Yeah.
capacity, and rates. How are load volumes and rates trending in 2020, gentlemen?
Flat right now. We had a pretty good fourth quarter. We had a good third quarter, a pretty good fourth quarter. I have a slide, I think. That one right there. So basically, if you can, right there it is.
Oh, nice.
So basically, it tracks tender load volumes from Sonar, tender rejection rates, which is a measurement of capacity for specific markets. And nationally, we have DAT spot rates. And then we have a proprietary quarterly carrier sentiment or confidence survey that we conduct every 3 months or on a quarterly basis here. And you can see a snapshot of 2019, and it started off pretty ugly. Are those ugly numbers, JP?
Yeah, there was a dramatic collapse in tender rejections and spot prices in the first quarter of 2019. If not volume, so it was mostly on the capacity side.
Yes.
We thought, and we kind of it's really hard to predict demand or volumes. We think that just even though the overall economy is slowing down a little bit, not sort of gradually. We predict fairly flat volumes. I think the coronavirus is actually a risk for at least the first quarter.
Wow.
It has the potential to. So there were reports coming out this morning saying that Chinese ports had declared a force majeure, meaning a circumstance outside of their control that prevents them from fulfilling.
It's like act of God.
So like they're having trouble finding port workers, or having trouble finding truck drivers. If that continues, it could deepen and extend the traditional Chinese New Year trough that you see in West Coast port volumes, and then that could knock on obviously to trucking volumes. We're still weeks before we can make that call, but that's definitely a risk for the first quarter. Other than that, I mean, there's a bad PMI number today.
And all the public companies that have come out with earnings, especially like Landstar, C.H. Robinson, they've been the J.B. Hunt too a little bit. It's been a challenging environment so far in January. So we see kind of a bleak outlook for how public companies are guiding down already. So
yeah, there are a couple of constructive factors though that we can talk about, and again, the volatility is going to be on the supply side or capacity. Yes. So one of the most interesting things that we call out is, of course, the Drug and Alcohol Clearinghouse, which is a database that is slowly ingesting violations and preserving them in perpetuity. And so as time passes, that will become more and more of a constraint on the supply of truck drivers available for dispatch.
And then that's accelerating in 2020, right? So it started January 6th, 2020.
Right.
It was supposed to build up. No one really knew the pace, but whatever that pace is.
The website didn't work at first.
The website didn't work at first. Exactly right. But that's going to accelerate. There's basically going to double because FMCSA came out in late December and said, traditionally 25% random drug testing of drivers. That's accelerating to 50% because they hit the 1% fail rate. Right. I think in 2018. So it's going to that database is going to accelerate and grow more quickly, and it'll take a lot of drivers it'll take a lot of drivers out of the industry because they're not qualified anymore.
Yeah. So I think that's something that should inflect, but through the middle of the year and the back half of 2020. I think in the first half of this year, the kind of the danger for 3PLs and freight brokerages and just third party logistics providers in general is that if trucking markets recover, if volume turns up, if we get more economic growth, and if capacity really does tighten, there's a likelihood that spot rates will come up at the same time that contract rates are still coming down, putting further pressure on margins. And that's a story that we've seen play out in earnings so far.
Yeah.
Both in J.B. Hunt, C.H. Robinson, Echo Global Logistics hasn't announced yet, but we expect to hear similar warnings from them. That's a real thing that could happen. And Hunt especially has said that they expect 4 to 6 quarters of sort of difficulty as they kind of convert their brokerage over to the digital.
I don't think a lot of us are surprised about what we're seeing in earnings right now. We knew the wolf was at the door, and now it's just coming home to roost, and we're seeing it. Some are hit pretty hard, like C.H. Robinson. A lot of the actual carriers themselves, not great earnings. USA Truck, not great. Landstar, not great. Boeing, terrible, right? I mean, on the land and the air, it's pretty bad, but break it down for us.
I think probably the companies that did the best were the railroads who, they're larger companies. They're more liquid securities, honestly. More people trade in and out of them. And they also have the benefit of having the Association of American Railroads publishing their volume data every single week. So it's fairly transparent, and they're much better at sort of managing expectations. They rarely get caught off guard.
But rail traffic was down.
Yes,
all through 2019.
Certainly.
You had PSR, precision scheduling. Is it precision scheduled? Or?
Precision scheduled railroading, yeah.
Yes.
And that's been a way for them to basically become more efficient and preserve earnings even as top line revenue goes down. And people are saying that that should be a good setup for when volume comes back. But the rails are going to be tied to your industrial production, chemicals, lumber, paper, heavy machines, gravel, stones.
So what about the carriers?
If we take a snapshot, actually, we have our quarterly survey of small carriers.
Oh, yeah.
Between like 5 and 100 truck fleets, and their confidence level is going through. If we can throw that slide up on the screen. Maybe we can't, but so basically...
Describe your slide
There
to
we
me.
go. There we go. Green is positive, red is negative, and yellow is about the same type of rate, line haul rate environment. And you can see that, Q4 was a little bit more positive. We're falling down a little bit. The negative numbers have come down dramatically, which is good. And the biggest gainer, I think, were people who think that Q1 of 2020 is going to be much like Q1 of 2019. And I think we've seen that so far, and that's with smaller carriers between 5 and 100.
Yeah, to me, what that chart looks like is a stabilizing environment, right? You've got positive sort of ticking up, negative sort of ticking down, but the really interesting one is people that expect the same sort of environment also ticking up and all kind of meeting in the middle. It sort of looks like it's almost divided into thirds.
Yeah.
So
we have a low rate environment. We also have accelerating. We did a white paper, a deep dive, about a 30-page paper on nuclear verdicts a few weeks ago. And what we found in the survey that we had in those strategies and planning, kind of that playbook for nuclear verdicts, is that on average, insurance premiums for trucking companies are going up 20% this year. So with operating ratios at an average of 98, 99 right now, especially for dry van haulers, you're seeing a lot of squeeze put on them, and we're likely to see accelerations of closures going forward in the first half.
In that environment, what's more important, volume or capacity, and what do you think is going to set the tone for 2020?
Capacity.
Yeah.
Capacity is much more. We could have, basically we were running, we finished the year 10%, load volumes 10% higher than 2019, which is very good. I think we can stay flat with 2019 and still have a low rate environment. I think it's all has to do with capacity. There's so much capacity brought onto the market and truck capacity in 2018 that's just got to exit the market at some point. And we were seeing signs of that really starting to accelerate. But it still could be 3 to 6 months, even 9 months in the future.
I have 2 points to make here. One is that one sort of negative on capacity, and by negative I mean something that would keep capacity in this too much capacity in the system, is that one of the biggest predictors of trucking failures is when diesel costs are going up. We think that diesel costs will continue to moderate going forward. The number of canceled trans-Pacific flights, the weakness in global trade, and just in general slowing economic growth has really put a drag on oil prices.
And the over-drilling.
And
over-drilling in the shale fields.
Yeah, so diesel, retail prices haven't been as volatile as wholesale rack prices, obviously, but we expect that spread to correct downward, which will give relief to trucking carriers, but it will, whether that's sustainable long term or not, who knows? The other thing that I do want to mention, that's something interesting we've actually just been working on today, is the data set with the Landstar business capacity owners, which I thought was really interesting. We were talking about in our Slack channel that if you look at the number of Landstar business capacity owners, or BCOs, which are their leased on owner operators, that can be a kind of a glimpse or a window into overall capacity in the market. So if you actually chart the percentage change quarter on quarter of the BCOs, you get a really good view of sort of carrier sentiment and carrier willingness to enter or exit the market, with the assumption that when carriers are optimistic about the trucking environment in the future, drivers are more likely to go out on their own and become owner operators. And when they're more conservative or fearful, they tend to either leave the market or work for an enterprise carrier. So that's been we're still kind of playing with that right now. It kind of looks like it correlates very neatly with spot rates on a 1 to 2 quarter lag. So after spot rates crash 1 to 2 quarters later, you see owner operators leaving the market, that kind of thing. We're still working on that, but that's kind of something I'm teasing for Passport Research.
Yeah, they'll be coming out probably next week or the week after.
Yeah,
as we do the research on that.
Yeah, what will you guys be monitoring? We have about 2 minutes left. So what are you going to monitor moving out of here to keep an eye on 2020? What are your key indicators? And we keep talking about forecasting. So what is going to help you forecast?
I think we're really worried about China and just the West Coast right now.
Wow.
That's a big thing.
It's that big of a concern.
Yeah.
Wow.
It really is, because, and it's not necessarily the death rate. That's not what's important. What's important is that the coronavirus is far more.
Well, wait, I would say that's. I would say that's important.
It's important. It's important, but I mean, it's not
in the context of what we're saying.
The death rate is not what's going to impact Chinese GDP, or industrial production or exports. What it affects that is the fact that the coronavirus is much more virulent and infectious than SARS, and therefore requires more drastic government control measures to control the infection. Things like quarantines, the restrictions on freedom of movement, shutdowns of commercial activity, things like that. That's what is going to affect manufacturing. That's what's going to affect exports and ultimately freight volumes in the United States.
Yeah, these factories. I mean, if you think about it, that's the worst place possible to have an outbreak, because a lot of these people live together in those dorms. They're on site and they're working a lot of hours a day in the same confined space.
So that's one thing that we're looking at near term. I think midterm is going to be what happens to capacity, especially with the Drug and Alcohol Clearinghouse. And then long term, of course, we need to know whether we're going to get, how much economic growth is going to decelerate, whether we're going to get like a soft landing in the recovery, and just what that kind of business cycle looks like. I mean, a lot of people are worried about high levels of corporate debt and things like that. So just a lot of that's uncertain because of the political environment right now and the upcoming election. But that's kind of like the long-term story is how this shakes out.
Well, thank you, JP.
Very
we
good.
appreciate it. Thanks for giving us that look on the outlook. Well, we touched on rail, we touched on intermodal, and now we are going to have Mike B come in.
Yeah, he's going to go in depth on both of those, rail and intermodal, and see what the outlook for 2020 is for that segment. How are you doing, Mike?
Doing great. Yeah, how are you guys?
Thanks for joining us.
Yeah.
We're doing good. So let's kick it off. What's your outlook for intermodal in 2020?
JP teased it too. He kind of said that you're coming in here with the good news compared to maybe some of our other panelists.
Yeah, I mean, most companies that are involved with intermodal are at least putting a brave face on things and saying in 2020, intermodal volume should be up. Now, that's coming off of a very difficult year in 2019 where intermodal volume was down about 5%, which is unusual for intermodal. We've been led to believe this is the sort of perennial growth area within rail. Consumer keeps buying more every year, and this is a more efficient way to transport goods. Everyone wants to make their supply chains greener. What could sort of go wrong?
Yeah, you wrote a deep dive about this not too long ago, maybe a month or so ago.
Yeah,
is the intermodal growth story dead? Or I don't know if that was the title, but it was along those lines.
It was close. I said, is it over at this point? And sort of, I think it's a legitimate question as to whether it's no longer a growth area, because volumes were not too far different than what they were 5 years ago, and it's actually underperformed truckload lately, and the rails don't seem to be putting that at the top of their priority list in terms of growing their intermodal volume. It's been more margins and cash flows and those things.
Guys, I have a question. We cover a lot of freight tech, and if you think about like Next Trucking, for example, they do a lot of drayage, especially on the West Coast. Mm-hmm. They had some cuts over there. So are they an indicator? Are they a bellwether of things to come? Are they correcting to the market? They did say they're focusing more on drayage, right?
Yeah, so
East Coast. I think they're opening up some things in Jersey and New York.
Yeah, so there's been a pretty significant shift from the West Coast ports to the East Coast ports, and it's been for a few reasons. It's not just the tariffs, although the tariffs play a role in there. Even before the tariffs, there was a shift in manufacturing from China to Southeast Asia, which is starting to be a lower place to manufacture goods because there's been inflation in the wages in China, so people getting paid more in China. So that's a good thing, and really the ports all along the East Coast, particularly in New York and New Jersey, with the raising the Bayonne Bridge, their capacities have expanded.
Yeah.
And that's where most of the population is. I mean, about 80% of the population is either on the Eastern or Central time zones. So it has the goods have a long way to go if it's via land bridge, and it just costs less to ship goods on water versus over the surface. So I think that's a trend that's going to continue, and I'd be positioning assets in the East as well.
Yeah, we have something in Sonar, the Panama spread, that measures that spread between going to the West Coast or the East Coast and the cost differential on those. On intermodal, trucking rates are low. Intermodal competes with trucking.
Yeah.
Or they base price based on trucking when the spread's high. When the spread's low, they really compete. How's that competition going?
It's fierce. I mean, it really is. And last year it was pretty unusual in that some of the lanes that you really think of as really being traditional intermodal lanes, like L.A. to Dallas is a good example of that. You think that's an intermodal lane, right? It would be 3 days to truck it, but a lot of truckers were desperate to fill up their trucks and made that a very competitive, lane. And so the railroads are facing stiff competition from trucking. Now, railroads don't like to cut rates. It's just really not in their DNA. And the railroads are making the legitimate claim their service has been good. Now, is it good because volumes are down, or is it good because it's, it'll be good, even if volumes recover? I think it's sort of
good because they say it's good, and you don't have that many options.
Right, and there's not that many different ways to measure it. It's kind of intermodal was 95% on time because that's what CSX sort of said. So,
their benchmarking group is one.
Well,
right?
it's just themselves. I mean, they say
we're doing good compared to how I usually do. But if that's a lazy person being benchmarked, right, then you're... So who's a better mother, though? Who's a better feeder to the rail? Is it the West Coast or the East Coast?
Well, the West Coast makes more economic sense. I mean, the issue with the East Coast is most of the population is within 1 day's drive from the ports.
Sure. Mm-hmm.
And so it just doesn't make a lot of sense in a shorter length of haul, by and large, to use intermodal. So it's a lot of that stuff just comes off the ports in the east and gets strayed to where it goes. So it just makes more economic sense from the West Coast.
So I guess what I'm getting at is there any concern how concerned are railroads if this trend continues of more volumes coming into the east? Because if they're coming in the east, it's robbing the volumes that they would be getting on the west because of the logic you just splayed out.
Yeah. Yeah, I mean, you would think they would be concerned. I mean, they haven't really said as much publicly, but you would think that they would be, and you would think that they'd be a little bit more open to entertaining rate cuts and those things. I mean, the only reason to use intermodal is that it's generally cheaper by 10 or 15%. Now, some of the rails have said, well, our service is so good, it doesn't need to be cheaper at all. But I don't know.
We'll see what happens.
I don't know if that's going to fly with shippers. It doesn't sound like it.
How about on the bulk side on rail? Bulk products.
The carload business.
The carload business, yes.
Yeah, I mean, I think sort of piggybacking on what Anthony was talking about with the slow industrial economy, rail traffic almost always grows if the industrial economy is growing, and the reverse is also true. It's almost always declines if the industrial economy is declining. And so 2019 was a tough year for the industrial economy, following a year in 2018 where unusually the rail traffic was better than the economic growth. So 2019 was a little bit more of a return to normal. Going forward, it's kind of things are kind of mixed. I mean, it's been a little bit more of just a resetting of the volume outlook. Some of the rails are talking about overall carload traffic being down just because coal is going to be so bad in 2020. Mm-hmm. It's CSX said all 4 segments of our coal are just kind of a disaster in 2020. So it's hard for some of those other segments to make up for it if there's just maybe a little bit of growth in the industrial economy, but it doesn't seem like there's much. I mean, the housing products Anthony talked about, pretty small in the portion of everything, and like the Canadian rails are big players there, but they've had issues with BC sawmills shutting down and those things because of the log prices being high.
Yeah. How about on 2020, the comps, the comps against 2019? Are we going to see kind of a flat rail, because we always get the weekly rail updates, right?
Yeah,
are we going to see flat numbers this year in 2020, or do you think they'll be somewhat positive, or are we set for another down year on rail traffic?
I think any of those 3 outcomes is possible. I mean, my sort of initial thought is that based on an easier comp, it'll be up a little bit. We're start to see positive comps when you get just a little bit deeper in the year. I mean, it's still a difficult comparison in January because the tariffs sort of wreaked havoc a year ago on some of the volumes. But I think it'll be positive for most segments of traffic, at least a little bit later in the year. What we don't know is sort of what JP was talking about is, are we really going to have this trucking capacity crunch, which would be a big deal, and most of the public companies are saying are on board with that. Maybe it's wishful thinking, but they're all sort of on, seems to be sort of the consensus that's going to happen.
Do you think so basically, if we don't have that capacity crunch, if we go through 2020, lose capacity, much like 2019, do you think the rails are going to get more aggressive selling intermodal?
I don't think they're going to get more aggressive on price. I mean, it's almost like if you look at like what Kansas City Southern has done in Mexico, the trucking rates in Mexico have collapsed because of the peso. So basically, the truckers get paid in pesos. Kansas City Southern gets paid in dollars. Pesos collapsed, so it's made it so it's very difficult to compete with the truck in Mexico. And so they say, well, I can't cut my rail rates because it's just hard to get them back once you've done that. So it just doesn't seem to me like the rails are going to do that, and they're just not going to get volume, and you're not going to see any volume growth if that doesn't happen.
That's so interesting how they don't really care that much, and they're not as reactive as your traditional truck carriers are, especially with the knowledge, and they must be well aware of this, that most shippers are doing that equation where there's X amount of miles where it breaks even, and the cost per mile on a truck dictates what that mileage is before shippers consider going to the rail.
It's good to be a monopoly.
I guess so.
Yeah.
I mean, does that say anything more about it than the fact that they're like, you know what? If the break-even point's 400 miles, it's 400 miles.
Yeah.
We're not going any lower.
Yeah. And with PSR, basically if it's unprofitable, just cut it out.
Yeah, I mean, Intermodal has never been one of their more profitable segments, maybe with the exception of the most dense lines like LA to Chicago on BN or something like that. But
what is like 4 lanes or 5 lanes carry 80 or 90% of all intermodal
it's
traffic?
like 7 lanes, 7 or 8 lanes do 90% of the traffic. So they want to push it to those lanes, and if something is originates or terminates too far from those rail ramps, it doesn't make sense to move it intermodal. Yeah.
Well, guys, thank you for joining us. It's
Sure.
time for,
definitely.
we're going to bring in FreightWaves founder and CEO Craig Fuller now, and our Chief Strategy Officer, it's JT Engstrom. Going to be exciting to hear from them what their outlook is on all of this, maybe a little freight forecasting.
What up, Dooner?
Hi, welcome to the booth.
Dooner, how are we? Going to talk about rebranding?
Rebranding what?
Well, let's see here. FreightWaves has rebranded 3 times before we got here, and JT himself rebranded when he came on board here.
Yeah, I figured in true FreightWaves fashion, I needed to rebrand as soon as I got here.
Yes.
You did. It was you're joining the club. Are this going to be rebranding this year, 2020?
I don't know if I can change my name again.
I don't think you can change your name, and we're not planning on changing our name.
No.
So no rebranding.
No.
There's no need to change the FreightWaves name anymore.
The brand's good.
pretty
There's
strong.
no more conflict with an exchange. There's no conflict with another operating company.
Yeah, exactly.
We're cleared.
We are. We're in good shape. Let's talk 2020.
Yeah, let's do that.
What do we got?
What's on the radar? What do you guys? So, what is your broad outlook? What's your outlook for data, for forecasting? I know we're putting a big emphasis on forecasting.
Yeah, so I think, this virus is actually a very, very serious issue. I think the coronavirus is changing all the models. And I think the challenge is that we don't know what's actually going to happen. I mean, if you look at SARS, this coronavirus already, in terms of infected folks, it's estimated to have already exceeded SARS. And SARS actually caused an economic recession in Asia. It caused a significant downturn in the Asian economy. This is a bigger deal. And U.S. airlines Delta and American and United have all cut off service. International airlines have cut off service. Italy banned Chinese residents from coming in. The United States is now putting any citizens that came from the affected zone are actually in quarantine. This is a really serious. This is the world's manufacturing and freight generator center of the ecosystem. I mean, this is a big deal.
Yeah, it's certainly a big deal. And then when you overlay that with ongoing trade negotiations and where we are approaching in terms of a presidential and election cycle, having these issues with China actually starts to materially impact not just policy, but also freight flows. And so then you talk about how does this impact freight forwarding, air freight forwarding? Is there a mix shift to international maritime? When those international maritime ships show up at the port, what does that mean for drayage? How does that get on the rails? Does it just go OTR?
Yeah, I mean, a lot of stuff that's air freighted tends to be more expensive. Pharmaceuticals do a lot of lift capacity. In this particular part of the world, it's a lot of semiconductors and electronics that are being air freighted, some e-commerce. The problem is you can't funge in terms of moving mode. It's very difficult to move from air freight to boat. It usually goes the opposite direction.
That's right.
This is when you lose that lift capacity, there's a significant issue. I will say one thing that may not be apparent to folks is if you look at where this is impacted mainland China, That part of China is effectively the Detroit of China. It's where most of the car manufacturers produce their automobiles. I looked it up. The economy of this part of China is equivalent to our Detroit. And imagine about putting a quarantine in the state of Michigan. That's effectively what we're talking about, a core part of the freight production. And a lot of auto parts are actually not only produced there, but they're imported from other places like Germany and the United States. And so this could have an impact on trade flows and freight flows.
Guys, I should mention that the phone lines are open as well. It's 423-710-9777. And we'd also like to thank Emerge for sponsoring this freight outlook that they're doing here. You know, also the phone lines are open on FreightWaves Radio, where all three of us will be tomorrow.
Absolutely.
Yes, this is like a comeback tomorrow, right?
And we're loving it. We
Yeah.
have, the one and only Shelley Simpson dialing in at 3:15. Road Dog Radio, FreightWaves Radio, station
XM
146.
Sirius XM 146.
Yeah, and a guy from NASA.
That's going to be good.
It's going to be fantastic.
Well-
Deep space trucking.
Getting a little bit deeper into 2020, let's put the virus aside because there's that could have a profound impact. Then again, it may be an isolated issue in China. I do suspect that it's going to have a dramatic impact on freight demand, and that's why we're seeing the stock market sell off, have a big sell off day, simply because of the concerns.
There's a lot of fear.
Yeah, a lot of fear. I don't think anybody wants to go into the weekend holding long positions in some of these.
No, you want to be
speculative
fully
stocks.
hedged going into the weekend. Yeah, absolutely.
So,
And so maybe it's worthwhile for us to set the stage in terms of where we're entering 2020, not just with respect to international viruses, trade, policy negotiations, but then also in the domestic economy and where we see ourselves both in surface transportation, obviously in air freight forwarding, and then amongst the rails, amongst international maritime, impacting those ports, and then the domestic Jones Act maritime shippers. Maybe we could talk a little bit about where we see those fundamentals and how that might play out over the next 6 to 12 months.
yeah, I think I would say I went into this year pretty bullish on where 2020, right in terms of the trucking market. We've not yet seen a surge in demand.
No, we haven't.
It's been very soft, and talking to carriers, the conditions are pretty soft even for some of the larger guys that are more exposed to long-term contract freight. It's still a relatively soft market. And so that I think the market still is oversupply of capacity. One thing I am hearing, and I am picking up a lot of this, is there have been discussions from some of the fuel vendors that some fleets they're not even filing bankruptcy. They're just they owned their equipment outright and they're just shutting down. And some of these are family businesses. And I think what we're seeing is companies just simply disappear and not leave a mark.
And I think to complement your point, Craig, there's two dynamics moving along with that trend. Is one, you are seeing carriers close doors, but then two, you're also seeing the acquisitive companies being pretty aggressive, going at these smaller family-owned businesses who actually have really new power units, because there was a big surge in deliveries in the beginning of 2019, and now they're continuing to run those power units, and they're saying to themselves, instead of going to the OEMs and purchasing brand new equipment on the primary market, why don't I just go out and buy a tangential competitor for perhaps a little bit below book value?
Yep.
Also get their contracts, also get their drivers.
The drivers are the most important piece.
Right. And you're getting relatively new equipment.
Yeah.
And
I don't have to take the bath of the owning it. The old joke is when you buy a car, a truck, or some type of vehicle, the moment you drive it off the lot, you've lost 30% of your value.
Exactly. So you're seeing this interesting dynamic where there's a positive correlation of both bankruptcies and acquisition activity as a result of this dynamic, which is kind of unique.
Well, the market does. I mean, the market is. This is if you looked at it from an economist point of view, it's the definition of a perfect marketplace.
The most perfect we've ever seen.
Yeah, so which is effectively supply and demand is everything. Pricing is truly supply and demand driven. And I think what we're seeing is we've had an oversupply of capacity relative to volume. We're having a softening in the market just relative to seasonality. And we saw the ISM numbers actually look like they had collapsed in December. They look like they were showing promise at the end of the fourth quarter. They're down again. We'll see where it heads. But I think the market's really soft. I think you're going to see a lot of capacity churn out. Insurance companies are going to put a lot of companies out of business because if you saw the accident fatality rates have gone up after the implementation of ELDs. I think it's going to be a really, really tough first quarter for a lot of the industry.
Yeah, that's right. And if we were to scroll back 3 months, there was a lot of fleeting green shoots around sort of the November timeline, which I think was a misinterpretation of
What is a green shoot?
It's a green shoot, so it's sort of it's a leading indicator on what can be perceived as a positive influence on an economic trend to be forthcoming.
Got it.
What about the dead cat bounce?
So I like that one. I like the dead counts better.
Yeah.
So
I know what that means.
A fleeting green shoot could also be categorized as a dead cat bounce, and so a lot of dead cat bounces
fleeting green
and
shoot,
fuller
yes.
here.
Yeah.
towards the end of November. I think a lot of carriers were optimistic that December was going to be great because of the volumes they were seeing, and it subsequently turned into a really soft peak season. And what we're now hearing, we've spent a lot of time traveling to the Midwest. We spent a lot of time with equipment manufacturers. We spent a lot of time with OTR carriers, even in just the last 2 weeks. Rates are down sort of mid-single digits year over year, net mix shift, conversion between contract and spot. Volumes are also down low single digits year over year. And as a result, everybody has really new fleets. Everybody is struggling on net revenue per volume. And then to your point about insurance rates on a per truck basis are up roughly 6 to 7% year over year.
And that is just in primary. The secondary coverage is as much as 2x to 3x, and some companies can't get it. I heard a rumor that there is a large truckload carrier in the top 25 that is on a temporary insurance policy because of their it's very hard to underwrite them. And this is a very large carrier. We've not confirmed that it is true, but the rumor is that a top 25 carrier is struggling to get insurance and a long-term policy. They're basically on a temp certificate. And so this is a big issue. Insurance is going to put a lot of these companies out of business. And for reasons we've talked about nuclear lawsuits, I think that is going to be a very pertinent problem.
It's interesting you say that about a top 25 carrier. You can whittle down to a short list of less than 10 pretty
I'm 99% sure I know who it is.
Yeah, I'm sure. Well,
It's
part of
not
that
it's not a public carrier.
Well, also part of that
private.
is because if you look at the majority of the top 25 carriers, a lot of them have their insurance underwritten by closely held insurance companies.
Yep.
And so, synonymous with the point you're making, insurance has been such a continuous, long-going issue for truckload carriers, which is now just getting exacerbated, that a lot of family-owned businesses actually started their own insurance companies so they can underwrite their own premiums. Right?
You have a
their own
captive. You get a captive, and it protects you. The problem is that secondary insurance, because of the nuclear lawsuits, becomes a pretty profound issue.
And carriers who didn't hedge their risk to this 5-10 years ago and getting into captives or starting their own circumstance are now finding themselves with lack of optionality and calling up Aon and saying, hey, what can you get from me in the market? Calling up Reliance and saying the same thing. And in reality, there's only 2 or 3 or 4 calls you can really make with someone on the other line that can try to answer your question.
Well, because they have to go to the reinsurer too.
That's right.
So it's not
they got to sell that offshore.
Exactly.
They're going to Lloyd's, and the problem is not a lot of the reinsurers want the exposure.
Yeah.
Some of the larger truckload carriers are buying. I remember, not more than 5 years ago, $100 million policy. Like it used to be when 10 years ago, it was $25 million.
Mm-hmm.
You went up to $25 million, you're protected. Then it was $100 million, and now the going sort of insurance, the top end of the market is $300 million. $300 million.
It's nuts.
And you have to do it, because if you don't do it, you very well could. I mean, name the number of companies that today could write a $300 million check if they were in an accident.
Yeah.
You're going to, except for the private companies and private fleets, you're probably talking about maybe 5 truckload carriers that could do it.
Mm-hmm.
5, 6. So it's a scary situation.
The coverage is going to be more than the book value of the total assets of these
there
carriers.
are a number of carriers,
awesome.
so it's
especially when you
scary.
look at the op leases associated with those asset bases.
It is a scary situation, but I think this is going to be a pertinent concern ongoing. I think so just looking at 2020 from an economic and freight demand standpoint, I think the virus. Oh, we have a call.
I think we have a call. All right, let's see. Let's bring it up. Hello, thank you for calling FreightWaves 2020 Freight Outlook. Dooner speaking.
Yeah, hello?
Hi.
Hey, yeah.
Do you have a question, sir?
Yeah, I had a question. So I know in 2019 we had a lot of trucking failures. They were at multi-year highs. I was just curious what everybody thought about the continuation of trucking failures in 2020, and if that was going to increase, and when will it show up in terms of rates?
Well, that's a great question. I think it's a great question. I would say that it only is going to show up in rates once we see capacity. So the thing you got to remember, and you just pointed it out, that bankruptcies does not mean capacity is leaving the industry.
No, I don't view it that way.
If you're, because just to your point, a Warner, a Swift, a Bison, a mid-sized carrier that wants to grow their fleet could buy those trucks and hire those drivers.
Mm-hmm.
What is actually going to eliminate capacity is the driver is the capacity shortage.
Correct.
Like, the driver is the capacity. They're the ones that determine the limit of
Absolutely.
capacity. It's when we see an environment where a certain segment of driver has been eliminated through whether it's the Drug and Alcohol Clearinghouse or any of these issues related to drivers underwriting. Any of those underwriting criteria is going to make it difficult. Now, I do think one thing that you have to, going back to the earlier point about insurance, is I think with the Drug and Alcohol Clearinghouse making records transparent, carriers are going to have to, their insurance companies are going to mandate very strict hiring criteria because of the nuclear lawsuits. And I think that's when we're going to see capacity leave the industry.
Yeah.
But bankruptcies are meaningless in terms of capacity outputs.
Totally agree. I would also say after really high peaks, there's sort of a perverse capacity impact because the fleets reinvest in primary equipment so much that fleet ages get really young. When the market begins to trough, they start selling off assets, compressing their total asset base, and owner-operators pick up all this great young equiment at a cheap rates in the secondary market, and it can't fuels them with these really low cost bases to continue to run in absurd market conditions.
Now, is Zach still with us?
No.
Oh, he's off.
Yeah,
Okay.
I think you answered his question satisfactorily. XPO and Amazon, are they going to set the tone for the year? They're some of our most read stories.
Did you see Amazon's earnings?
Yeah.
I mean, and the
Incredible.
thing that was very interesting about Amazon's earnings was that the credit they got was in their managing of shipping costs. That was the headline news, and CNBC reported it. The Wall Street Journal reported it. Basically, that they control their shipping costs. Now, I will argue two things. One is they've built out their own transportation network, which helps them optimize their model. And the second is transportation costs have been down significantly year over year, or at least if you're buying in these markets, particularly around peak. I think they benefited from both factors.
Yeah, no, they've done a great job actually managing their transportation network in the face of a fleeting relationship with both XPO and FedEx. And actually, now that you say this, Fred Smith came out with a big announcement a day or two ago.
He's going to beat UPS.
He's going to beat Amazon.
Oh, okay.
He said, the winner will emerge, and announced publicly they're going head-to-head with Amazon, which is an interesting announcement. And so we'll see how that dynamic plays out.
I love Fred Smith. I am a Fred Smith. Like, as a kid, he was my hero. He still is my hero.
It's a great story. Flying Tigers. I love it.
But let's just remember that Fred Smith was also the person 2 years ago that said Amazon is not a competitor. So
yeah,
he is a brilliant person, built an amazing company. He's probably one of the greatest, at least our generation's greatest logisticians. However, he's also made some proclamations that have recently not proven to be true.
The tea leaves are posted on the wall.
I think I struggle to think that the problem is FedEx only can make money in logistics,
and they only move freight. They don't control the
freight.
baseload capacity.
That's true.
That's the
and
challenge.
they don't have the other services to augment. And the advantage Amazon has is they don't actually have to make money in freight.
Yeah.
They just have to fill up a network. So if you think about the cycles of Amazon, a lot of their freight moves in Q4. But if they build out all this capacity, Q1, Q2, they have a lot of capacity.
We got a phone call.
Uh-oh.
Yeah, hi. Thanks for calling Freight Outlook 2020.
Hey,
Dooner
Charles.
speaking. Hi, Charles.
Hi, yeah. So, hey, thanks for taking my call. So, I'm graduating high school soon. Like, I have my family's like all in transportation and all that, and I'm thinking about like getting into driving myself, like being a truck driver. I'm like just interested in wondering if like that's like a good market, you think, or is it like a good time to become a driver?
Okay. Yeah. Do you think it's a good time to enroll?
I mean, he's got to be 21 if he wouldn't drive over the road.
That's right.
First of all,
Unless he's in Canada.
He could drive intrastate.
Yeah.
I mean, he could be a local driver.
Do a box truck.
I don't know much about his background opportunities. certainly the great thing about being a truck driver is there's always jobs available for you, and it's a job that you can you have a lot of opportunity because there is certainly a lot of demand for truck drivers. And I think broadly, just talking about logistics experiences and opportunities, I think it's a very important sector. So starting out on a dock, I mean, think about how many freight executives have at some point worked on a dock. Did you ever work on a dock?
Yeah, when I was at Talbot's, I worked for 2 weeks and I hated it. But I had to do like garments on
I
hanger.
had a little bit longer.
I
I was on a dock for over a year.
Yeah.
I was selling, but I ended up wrapping freight to get my freight at times.
Yeah.
But it's interesting when you talk to some of these senior executives who started somewhere in either as a driver or as an operations person or on the dock, and they work their way up into these organizations. So certainly if you're thinking about leaving, and thinking about post-graduation, what that looks like, getting into some of these entry-level jobs, whether it's driving or working in operations or on a dock, is a great move because you can always move into other roles. And there's always a demand for drivers.
Yeah, and it gives you a really deep appreciation for the various functions of the transportation industry. We can actually see how capacity moves.
For sure,
Does the 21-year-old who becomes a trucker now, is there any realistic thought to them not having a job by the time they retire because of automation or any of those things?
No, and I'll tell you why. If you look at the average age of drivers at 52 years old,
yeah,
even in a world of automation, there's going to be parts of the supply chain that require driving professionals. But if you look at it, it's like saying the equivalent of, if you go back to like 1900, somebody who was a buggy driver.
Yeah.
Should they be worried about not being able to haul buggies? I mean, there was about a 20-year cycle where you still had horse carriages and cars on the road. It's just that shifted. So, and the thing about driving is it's a fairly easy job to get in and get out of. And to what we talked about earlier is this is a job where you learn the basics of logistics. Mm-hmm. We all the three of us just in this room have come from very different backgrounds, have had very different sets of experiences. But learning those roles informs your career later on. And frankly, the age of drivers is always going up, because the average age, because people aren't entering the industry.
What about this debate? What about this? So if you became a driver or a broker at 21, who's more likely to become extinct first? I think maybe
I'm
the
going to
broker.
argue the broker.
Yeah.
I mean, unfortunately, I think the brokers as a job function are at bigger risk.
There's always a need for capacity, but in terms of being the intermediary between the actual shipper and the provider of capacity,
I got to ask. I mean, this is an interesting topic. I mean, we talk a lot about the industry and the market, but what happens to the brokers in these cycles? Like, are we at a point? And I've been saying it for 4 years. We've been predicting the death of the voice broker, like we've been talking about it for a few years. Is this the year that we see the fallout? I mean, if the bellwether is C.H. Robinson, and look, everyone loves to poke at them because they're the biggest, but they are the bellwether of this industry.
Absolutely.
If they're struggling,
they're really struggling.
Is it a suggestion that the business model of freight brokerage as that generation is that dying out, or is that ending?
What's interesting is there was two very polarizing narratives, one being that it was very relationship driven, another being that brokerage could be fully automated, and what we're seeing is a convergence of these two narratives, and such that it is a relationship business, but you can also, through digitization, increase the productivity of those relationships by doing more transactions per broker per day or some other period of time.
For sure.
And what you're seeing is, to get just as many transactions done over a given window, you need less and less brokers to actually manage as much and still manage the relationships.
For sure. And I think one of the things that's happening is, if you think about the generation of freight brokerage, say 5-10 years ago, the value of a broker, or at least their opportunity in the marketplace, was based on two factors. One is their ability to have information that nobody had, and so that lack of transparency and opaqueness, it benefited them. And the second thing that they benefited from was getting access to capacity when no one else could, and having a group of carriers that was dependent upon them. But what's happened is all of those barriers have fallen apart.
Yeah,
the market is far more transparent than it's ever been, and the ability to find capacity, especially in last year, is pretty instantaneous. And I think those factors are negative headwinds for the traditional voice broker.
Yeah. Yeah, I think the traditional voice brokerage market is going to be really there's a lot of secular challenges, which I think will persist throughout the cycles. And over time, that will continue to compress gross margin percentage and will continue to compress the total number of brokers as a function of total transactions in the space.
I tell you who I'd be long. I actually had someone contact me this on Twitter who's in stock market fund, and they asked my thoughts on Landstar. And whether because I had made some comments that Amazon and Uberization are going to ultimately change this market. They asked if I thought it was true for Landstar, and I don't think so, and I'll tell you why. I think Landstar's business model really benefits from the long tail of relationships. It's if you think about who will survive in a market where digitization takes place, it is basically it's organizations where they have either specialized types of freight where it's project based and you need human intelligence, it can't be easy commoditized, or it's very relationship based where the traffic manager is your uncle, it's your cousin, it's the guy you went to college with, it's the dude you go golfing with or go to church with, where you have 3 or 4 major customers and they are the majority of your freight. And those relationships are very, very hard to, they're not as concerned about the market, and you can call this gap. I think Landstar is well positioned for that.
Yeah, I would agree with that. And to expand on your points, one, they have a very specialized business. 2, it's an agent-based business, and the agents, to your point, have great relationships. But then furthermore, on a financial level, Landstar Corporate, because they're an agent-based model, instead of having exposure to gross margin percentage, they're taking a total net income over all their agents.
Bank. Are they not just a bank? They're a bank and insurance. They're a BPO. They're a business processing outsource.
And $485 million in cash and cash equivalents on their balance sheet, and they don't want to buy anybody because they don't want to piss off their agents.
Well, I don't blame them. I would love to be down in Jacksonville hanging out at their golf.
Special dividend time.
They have a great business model, and
yeah.
it's interesting. I've talked to some of the digital platforms, and it's like the business model. If I were to go create a digital broker, it would not be the kind of trying to centralize freight, the Uberization, the convoy business model. A ton of respect for them. Yeah, it's a very capital-intensive build, and it takes a lot of capital.
There's a lot of capex.
But I love Landstar's business model and a digital version. A digital version of that. If someone were to attack it, I would be thinking about how do I make the individual participants more efficient. I think Landstar's got the perfect business model.
Yeah, Landstar's great. It's sort of your agents are your own individual business owners, and we will help support. And they're
insulated because if you're a college roommate, if you're doing freight. Why and a digital platform shows up, you don't know them. You trust this person. Small businesses, a lot of them are small businesses.
Absolutely.
You trust the people you've built relationships with. And I think that is going to survive and thrive in this environment much more so than some of these large commoditized freight.
Yeah, and synonymously, you see a similar angle that Worldwide Express takes in terms of SMB.
I love their business model.
And they also have the incremental value proposition offering through the parcel contract they have with UPS.
It's a great, Joe Klum. Shout out to him and the folks at Worldwide because they have one of the most impressive business
really
models.
Sharp guys.
They hire aggressive sales folks that they have. These are the folks that would in the old days would have been selling copiers or pharmaceuticals and are now selling.
What are you selling now? I don't know.
Right? It doesn't matter what it is.
Yeah, they show up. They call on small business owners and they pick off the freight that. Is as in terms of individual volumes, the long tail. If the long tail is going to survive and thrive, and they build a model where they're picking off the freight that UPS and FedEx, customers aren't big enough to be able to have personal relationships with UPS or FedEx, they're not important to them, and they don't care. It's a rounding error. But when you bring it all together, you have this massive machine, which is a massively interesting sales culture. Where you're literally calling on doors.
And by the way, if you want to have an encore or a complement to that, why don't I have my next biggest line of business within that with the highest gross margin percentage be an LTL brokerage, which is actually pretty complicated.
Exactly.
And they have consolidated relationship on the capacity side, which is dynamically different than truckload.
And then occasionally I might get a truckload out of it. And that's
if I get a truckload, great, but I'm not going to bank on it.
Well, but you can't build a brokerage business in truckload on small business unless you have very small costs, which Landstar can make it work because the guy can do 20 loads a month and he's got enough margin in it because he's friends with the people around it.
Right.
Whereas most freight brokers can't survive on very small volume shippers. It takes a lot of work to acquire those customers. But Worldwide is the perfect model because they have the parcel, which is high volume.
Yep.
They solve parcel and e-commerce issues. They have the LTL as complementary. And then when a truckload happens, they're able to optimize it.
Now, you know who's taken a totally different angle on this, but has also similarly done very impressive things is Transportation Insight.
Okay.
And so they had a really deep origin in managed transportation, managed tons of relationships, helped be sort of the central command and control for a lot of these shippers, and then simultaneously said, well, why don't we purchase a full truckload broker so we can start monetizing the transactions around our ecosystem? Yeah. So they can actually direct all of the freight because they're managing the portfolios for a lot of these shippers.
Yeah.
And it's similar to something that Transplace is doing as well, and they're both actually really great business models.
So
yeah.
You can't go to a conference without hearing at least one old guy on a stage in a panel say this is a business built on relationships.
Mm-hmm.
And you mentioned relationships. Is it still a business built on relationships? Is tech changing that? Is that bullshit?
You have two sides of the world. So what the digital brokers are trying to do is they're trying to go after the high volume shippers where relationship is a secondary element, where it's, if you think about it, and the ones that they've been public about, I think every one of them have a relationship with Anheuser-Busch.
Yep.
I mean, AB, Unilever. These are high volume shippers where the person making the decision, there's a procurement department running the bids, or at least overseeing the process. They're looking for cost savings. They want to see savings come out.
Yep.
They want to benchmark their performance. And the person managing the transportation spend has two jobs. One is to drive costs down and then second is to make sure they don't have inventory stockouts. That person doesn't care as much about the relationship. It's important to them, but all created equal, it's about price and it's about efficiency and it's about optimization. That's what the big digital brokers are attacking.
Yeah.
They're going after and they're winning those bids because they're able to deliver significant cost savings. Now, counter argument to that is they're using venture capital to effectively buy share.
They're subsidizing share. Yeah.
Fair. They're doing it. No one's denying that. But so those businesses, if you have a high volume and AB as a customer and you're not able or willing to subsidize it, chances are your relationship, the business that you're getting from that is at risk. However, going back to my earlier point, when you get into the long tail where you're dealing with very specialized freight movement, maybe it's oversized, maybe it's hazmat, maybe it's convention or entertainment logistics, human expertise matters, and you can't digitize that easily or efficiently because it's part of a niche. Or it's relationship driven because the person who's buying freight is not required to optimize their spend. There's no pressure from corporate. Maybe they own their own business, or maybe they work for a business that doesn't track transportation spend as a function of procurement, and those areas relate.
Hard to sell too. Like if you've ever done sales or RFPs, those are always the hardest one. He doesn't care.
He's done business with Johnny for 30 years. They golf together. They go to church together.
You actually might make him look bad if you reduce his spend by too much, because then someone upstairs goes, "Wait a second, why is it 25% less?"
Those relationships are, and that's going to power. Look. If you look at the agent models, Global Trans has an agent model, Landstar has an agent model.
Mode.
Those are going to really, Mode has. Those are going to do well in this environment.
TTS.
The guys that are truly high volume are going to really struggle.
Yeah.
AB is a unique example because they also have franchisees who own distribution centers and their own trucking assets who can be their backstop for service and capacity in case something happens in the brokerage market.
When I die and I come back in my next life, there's two I want to marry.
He'll do another podcast before that.
Probably.
And one for the afterlife.
Yes, exactly. One for the afterlife.
It'll be streamed live on FreightWaves TV. By the way, tune in 10 a.m. So.
I want to come back as a railroad executive son.
Okay.
Yeah.
And I want to marry a beer distributor distribution, because those distribution licenses and beer distribution, they control a lot of freight, but they're licensed to print money.
They're basically guaranteed volume contracts because you can project what the beer consumption is going to be in your distribution market.
And it's all marketing.
And then you're told by Anheuser-Busch how many assets to purchase and seat.
Yeah, well, it's not even the transportation
day
side, but it's basically, the way these businesses work, and I did business with one in Texas, is the corporate, the brand is paying all the money for marketing. They give you money to go spend.
Yeah.
And you're just fighting for share. You're making sure the restaurants, but it's a license to print money.
That's right. And in some geographic areas, there's regulation which determines who can or can't actually distribute.
Yeah.
So if you have the license with a distributor and you're the only one approved by the state or the region or the county, there's literally no competition. You've got a monopoly on distributing like Budweiser.
Yeah, for someone who doesn't drink alcoholic beverage
Sure.
and drinks non-alcoholic, I have one brand that I love is Old Dole's. The challenge is if they're not an AB, a restaurant or bar, I get stuck with some off-brand or some alternative. So
It's not worth it then.
no.
All right, guys, we're running low on time. Anything to summarize Freight 2020, the outlook?
Look, I think this year is going to be a continuation of 19 in terms of market trends, but I do think the market volume, and I want to qualify this to say, assuming the coronavirus can be contained, and it isn't, we don't see a global epidemic, then I think we'll see a situation where we see the market start to really, capacity come out of the market earlier this year because of insurance and nuclear verdicts. But freight volume will stay pretty steady, and I think because of that, it should be a good year, the second half of 2020.
Yeah, and I think expectations have been right sized, and you saw that in new equipment orders in 2019, which will be delivered in 2020, and as a result, to Craig's point, 1H 2020 might be challenging, 2H 2020 could be a little bit better. Now, God forbid, an element of force majeure occurred, it could throw the supply and demand dynamic out of balance, which could be a positive catalyst for the industry space. And I think, given the setup and given the expectations of the space, both in the shipper and the carrier community, we're better positioned now to have a positive bias on what could happen in 2020 versus the beginning of 2019, where it was a fairly negatively biased outlook.
I have to ask, and I'd like to get both of your thoughts of this. If coronavirus is a non-global event, but it's contained in China, from a freight standpoint, my heart goes out to the people that are impacted, so I don't want this to sound heartless, but from a freight standpoint, because that's the purpose of this, is who are you long and who are you short?
That's an interesting question. So I think I would be long incremental domestic production, which
food production. A lot of food is actually packaged and processed in China.
Yeah, that's right.
Do you really? I mean,
domestic production. I'm saying, right?
Yeah. I'm saying I agree, but a lot of it's produced in China, which means demand for U.S.
Both food, both goods, tangible goods, assembled goods, primary inventory, and the interesting thing about domestically produced goods as opposed to imported goods is there's a multiplicative impact on domestic production because of all the intermediate moves associated with creating a final product.
Yeah, I think supply chain executives are going to scramble to find domestic production sources.
Mm-hmm.
Well, the good news is they've had at least a year to figure this out or think about this, so they'll be better prepared. What about you, Dooner?
Well, I'm looking at it from the perspective of the Phase 1 trade deal, and what if China can't consume as much as they promised in this deal, and then Donald Trump blows that deal up. It'll be interesting to see what that does, because that could cause another domestic freight recession, because we're going to lose the volumes coming here. It could cause a whole new series of problems.
I have two theories on this, and I agree with
more
you.
Tweets.
But I think this is going to have a negative impact to freight. And I'll tell you, my view is, first of all, air freight is going to go to hell.
Mm-hmm.
Like the air freight volume is going to get completely, because Asia is the world's center of in terms of freight production, that's a massive part of the world economy.
This Boeing thing too, the 737 MAX, it hit everybody in their earnings, and it's not going away anytime soon.
No, so the air freight market I would be short on.
Mm-hmm.
I would also be short on the container lines, because what's going to happen is the domestic Chinese economy is going to slow down.
Yep.
Manufacturing production is going to slow down. People are going to be afraid of just the impact of that element. And I think even the ship lines may end up rerouting traffic to avoid putting their ships to be stuck there. So I think this is going to be a pretty big impact. I agree with you. I think domestically, it may be long. It may be long for truckload.
Yeah,
Maybe long for the railroads.
That's right.
It may be a benefit to that. Now, it will slow down. The problem with this is, if you look at every major in the last 20 years, every major commodities crash has been caused by Asian lack of production. We saw it in late 99, we saw it in the mid 2000s, we saw it in 15. If we have a domestic slowdown in China, and it brings the world economy and the commodities part of the economy to a grinding halt. Oil prices could crash.
Yep.
Steel could crash. All the metals could crash. We could see a significant global slowdown in overall economic production. If that happens, all bets are off. That is not good for freight.
Yeah, a few mass outbreaks in factories there, and that's going to change things dramatically.
Well, I saw today there was students were blogging about how it's almost an apocalypse. This is a city with 50, an area of China with 54 million people, like an apocalypse. Like
really,
you've seen these movies, the one with Will Smith and
Contagion.
That's what
I saw last night actually.
I haven't watched that. Yeah. I'm not going to watch any of those. but did you remember the one where there's the zombies?
Yeah, no, that not iRobot is a different one.
No, he's got a dog in it.
I know what you're talking about.
And anyways, that's if you look at the photos, what it looks like is it's like Will Smith running through this apocalyptic zombie apocalypse. That's what it reminds me of, at least looking at the photos. These are cities with 50 million people. Nobody's out there. In fact, the statement was by the student was the only time he sees people out there is buying food. And so we're going to see a dramatic impact to freight demand.
I am legend.
Someone thank you. Who do we have to thank for that?
Jonathan Smith, actually.
Oh, Jay Smith.
Of course you knew, yeah.
Yeah, of course you did it. But that's a great,
it's a good flick.
Yeah.
It is a good flick.
I think it'd be tied back to Will Smith.
Based off a book, too.
Yeah. I mean, the challenge is this could get exponential. It is a virus, literally, and I just don't think China is prepared. And obviously, and they don't have it. So, anyways.
All right, guys. Well, we'll be on radio tomorrow. We'll continue the conversation. We'll be talking about, I guess, the 2020 outlook with JB Hunt, with Shelley Simpson from them.
Yeah, I'd love to get her, Shelley's thoughts on what's going to happen from an intermodal perspective, and more importantly, if anybody knows the digital brokerage business, it's JB Hunt.
That's right.
Yeah.
That's right.
And then the future of supply chain with NASA, what they're doing.
Oh, that's going to be cool.
Yeah, that's going to be fun stuff. So that'll be on SiriusXM, channel 146, 3 to 5 p.m. Eastern Time. So subscribe, download the FreightWaves TV app. You can rewatch this if you missed any of it and hear the great outlook for 2020, right? Thank you to Emerge. Go to FreightWaves.com. Also subscribe to Freightcast to get all of our podcasts. Until then, take care.
Take care. Thank you.
Yeah. Thanks, guys.
The Emerge Digital Freight Marketplace, the fastest, easiest way to manage your carriers and brokers, and receive live direct rates from vetted carriers outside of your network. Users are saving upwards of 20%. The Emerge Digital Freight Marketplace. Quote, tender, track, save.